You've heard it before, the higher the risk, the higher the expected return. So between a low-risk stock and a high-risk stock, you'd expect the higher-risk stock to offer a higher return. But how much higher? What is the correct return for taking extra risk? And how is this return applied in actual practice, especially for investing? That question sits at the center of modern finance. One way this was addressed was via the capital asset pricing model, or simply the CAPM. Today, we'll explore this from both a theoretical point of view and from the point of view of actual practice. I've had some experience with CAPM in actual practice due to some M&A valuations I was involved in before. So I'll share this and other things, especially for investing in stocks and for corporate finance. The CAPM tries to answer a deceptively simple question: how should risk affect expected returns? While following the work of Harry Markowitz in modern portfolio theory, a new idea of reducing risk via diversification was planted. The idea was that investors will only select stocks whose returns will tend to smoothen the standard deviation of the portfolio returns, dramatically reducing risk. When taken to its logical conclusion, following assumptions of rational investors and markets, then everybody should be holding the market portfolio because that way all risks coming from risky assets are diversified away. That means there's only one risk left: systematic risk. The risk that remains because you're precisely invested in the market, therefore only the market risk remains. Everything else, the unsystematic risks, have been diversified away, and following Tobin's two-fund separation idea, people only invest in the risk-free asset and the market portfolio. The CAPM formula. You might have learned CAPM via your finance classes in the university or your MBA courses. The expected return on any asset is written as expected return is equal to risk-free plus beta times the quantity expected return of the market minus the risk-free rate, where RF is the risk-free rate, beta is the sensitivity of the stock to the market portfolio, and expected RM is the expected market return. To reduce the clutter, let's just rewrite this as follows. Note that this can be rewritten in the following way. This means if you're attempting to compute for the CAPM beta, you have to adjust both asset returns and market returns by the risk-free rate of return. In other words, you're regressing excess risk on both sides, the stocks and the market's excess return, not the actual returns. Market return minus risk-free return is normally referred to as the market premium, the market return in excess of the risk-free rate. So otherwise, if you're regressing the raw returns of both the asset and the market, you're computing what's called the market model and not the CAPM model. The market model looks like this. And note how it's different from the CAPM expected return. So what is beta? Beta measures how sensitive an asset is to market movements. A beta of 1 means the asset moves roughly with the market. Above 1 means it's more volatile or riskier than the market. Below 1 means it's less volatile or less risky than the market. It's all very much related to the correlation coefficient. In fact, mathematically, beta is equal to the correlation coefficient rho times the sigma of the asset all over the sigma of the market, where the market returns are on the x-axis and the asset returns are on the y-axis. So the intuition is simple. The more your investment amplifies market risk, as observed via a higher beta, the more return investors will demand, because after all, they're taking more systematic risk. This leads us to the security market line. The CAPM produces something called the security market line. It's a graph where beta sits on the horizontal axis and expected return sits on the vertical axis. According to CAPM, low beta assets are less risky and should offer lower returns. High beta assets are riskier and should offer higher returns, and the relationship is linear. More systematic risk, more expected reward. This became one of the foundational visual frameworks of modern investing. Now, what are the actual applications of CAPM? Application number 1, as buy or sell signals for stock investing. If the expected return is above the security market line, what does that mean? Wait, this is confusing. Isn't CAPM giving an expected return as well? So what does this question even mean? And of course you're right, that's confusing. So right now let's talk of two ways to get expected return. Our usual way was via the weighted average expected return, or the average return, which is simply the sum of the returns all divided by n. And then we have this CAPM expected return as given by the formula. So going back to the question, if the weighted average expected return is above the security market line, is this a buy or a sell? If that is true, this means that the stock is undervalued, with prices too low, so the weighted average expected return will produce returns that plot above the security market line. This is a buy signal. Eventually, as rational markets pursue the stock and prices go up, the weighted average returns eventually go down and should align near around the security market line. Now, the reverse would be true. If the weighted average expected return is below the security market line, then prices are too high, producing a weighted average expected return lower in comparison with the security market line, or the CAPM required return. Rational investors will sell the stock and prices should fall, eventually aligning expected return with the CAPM required return. Theoretically, that's how things should work. And for now, let's just park this idea and return to this later after discussing problems with CAPM. Second application, to compute cost of equity. One of the biggest applications is estimating the cost of equity. Suppose a company wants to evaluate a project. It needs a discount rate. CAPM is often used to estimate the returns shareholders require. For example, if the risk-free rate is 4%, the market risk premium is 6%, and the company beta is 1.2, then the required return, or the CAPM expected return, is 11.2%. That 11.2 may become the firm's estimated cost of equity. And that feeds into discounted cash flow models, valuation analysis, and even capital budgeting decisions. And because of this, CAPM is also embedded inside the weighted average cost of capital, or WACC. Companies use the weighted average cost of capital to evaluate acquisitions, investments, and corporate strategy. And the cost of equity portion often comes directly from CAPM. Now we go to the weakness of CAPM. CAPM is actually quite problematic. The first weakness, beta doesn't explain everything. Empirical evidence showed beta alone struggles to explain returns. Some low beta stocks outperform. Some high beta stocks underperform. Researchers discovered other important patterns that led to improvements over CAPM, especially the Fama-French three-factor model that explained the size anomaly and the value anomaly. And for that, we refer you back to our previous video, the 7 ideas that shape stock investing. Weakness number 2, unrealistic assumptions. CAPM assumes investors are rational, markets are frictionless, borrowing and lending occur at the risk-free rate. Investors share identical expectations, and everyone optimizes portfolio similarly. But reality is far messier. Behavioral biases, transaction costs, taxes, liquidity problems, and institutional constraints all matter. And then perhaps the biggest weakness number 3, the market portfolio problem. So the biggest handicap to CAPM is that it theoretically requires a true market portfolio. Not just stocks, but everything. Stocks, bonds, real estate, commodities, private businesses, perhaps even human capital. But nobody can fully observe or measure that. So practitioners usually substitute a stock index like the S&P 500, for example, or whatever else is handy to use as a market proxy. That simplification creates problems because theoretically, the market is everything risky, not just listed stocks, but still, market proxies are being used, and these are just basket of listed stocks instead of a basket of everything, what we call the big basket, when we talked about our 7 ideas video previously. But what are the strengths? CAPM has survived for decades because it has several major strengths. Its simplicity, the intuition it communicates, how widely it has been used and understood despite its flaws, and the foundational role it played in communicating risk and return ideas. So in conclusion, the CAPM is both elegant and unfortunately flawed. It offers a clean answer to a difficult question: how much return should investors demand for taking risk? And here are my own key takeaways from my actual experience. So go ahead and use CAPM like for valuations, but don't expect it to be the final basis for the value of a firm's equity or for determining if a stock is a buy or a sell. For that, we need to go to more basic fundamental discussions like difference between intrinsic value versus price. You'll have to know that different methodologies will produce different values for the equity of a firm. But for M&As, for mergers and acquisitions, what matters will be the price the buyer is willing to pay and at which the seller is willing to sell, regardless of the valuation you submit. So we go back to the issue of value versus price. In this sense, the CAPM and its resulting interest rate for valuing equity is just one tool among many. But remember, price is what actually happens in real life. That is the market speaking in dollars and cents. So, CAPM has value, but take it with a grain of salt, and it's not the final say, especially when money needs to change hands. But for internal purposes, for example, as long as there's consistency across time, it can be used to measure internal valuation processes for corporate finance and measuring weighted average cost of capital, for example, save for internal capital allocation issues. Well, I hope that was useful, and that's all we have for now. In the meantime, please like and subscribe to help support the channel. See you next time!